Hi everyone, today we will discuss the topic of common mistakes in financial projection. Financial projection play a key role in strategic planning, fundraising and internal decision making. However, it can be challenging and mistakes are not uncommon, often leading to misleading, overly optimistic or unrealistic forecast. Being aware of these can help the business to create a more reliable and actionable financial model. They are only as reliable as the assumptions and the logic behind them. And today we will walk through the common mistakes business makes in financial projection and how we can avoid them to ensure our model are credible, actionable and investor ready. Number 1. Overly optimistic assumptions. This is probably the most common mistake. Business owner and manager often assume aggressive growth, low cost, or large market share without validating those assumptions. Instead, projections should be grounded in market data and past performance where possible. Being realistic builds credibility with stakeholders. Otherwise, it could symbolize overconfidence and the dangers of the unchecked ambitions because you are assuming small plant instantly turning into a tree. Ignoring seasonality or cyclicality. Projecting flat or straight line growth fails to capture the real world fluctuation. Many industries like retail, tourism, or agriculture have strong seasonal pattern. Ignoring these can lead to poor cash flow planning and inventory issues. We need to review the past data, industry pattern, and build seasonality into our model. Financial projection must represent ups and downs over time, perfect for seasonality or cycles. Underestimating cost. Many projections look good on the surface because they exclude key costs like marketing, compliance, and support. Marketing, especially in the digital and tech business, can consume up to 30% of revenue. Let's be thorough. Include all fixed and variable cost and contingency buffer should be added. Just like tip of the iceberg above water is our visible cost and massive base below could be the hidden cost. Not tying assumptions to reality. Financial should always tie back to operational driver. For instance, rather than assuming 2% market capture, forecast revenue based on the web traffic, conversion rate, and average order value. This makes the model more transparent and easier to defend in front of investor and auditors. Otherwise, projection made without involving operations or data makes operators in background confused and represent customer journey or supply chain with question mark over key stages. Inadequate cash flow forecasting. Profit does not equal cash. This make often leads to liquidity crisis. If we sell on credit or hold large inventory, we need to model cash collection and payment schedule properly. Always prepare a full cash flow forecast in parallel with the income statement and balance sheet. In this image, empty wallet represents lack of cash despite good performance on paper. Lack of scenario planning. One projection is not enough. A best case, base case, and the worst case scenario helps stakeholder understand risk and flexibility. It also prepares management to pivot if reality does not match expectation. Sensitivity analysis is a great way to show how key variables affect the bottom line. And here dies with uncertain outcomes represent unpredictability and the need to prepare for the different scenarios. Ignoring market constraint. Every market has ceiling. whether it's customer demand, regulatory limit, or operational capacity. Overlooking these constraints lead to overprojection. Realistic forecasting requires knowing your total addressable market and internal capabilities. Just like in this slide, brick wall in front of a business person represent hidden or ignored barriers to execution. Inconsistent or incomplete financial statement. Sometimes we see income statements that do not tie to the balance sheet or cash flow, or retained earnings don't reconcile. This erodes credibility quickly. Always use integrated financial model where changes in one statement flow through the others. Consistency is the key. And this puzzle with missing or mismatched pieces represent financial statements that don't fit together properly. No time-based logic. Revenue and cost build up and should reflect time. Product development takes months. Customer acquisition has lead time. Avoid forecasting instant profitability. Instead, show a ramp up period for cost and delayed revenue recognition based on the sales cycle. Failure to update projection. Projections should be a living document. If we don't revise them based on the actual performance or market changes, they become irrelevant quickly. Build regular review point into your calendar. Quarterly updates are a good standard practice. Neglected development cost. R&D, testing, certification, and regulatory compliance can represent significant cost, especially in regulated or technical industry. Many overlook these in the early projection. Under IAS 38, some of these can be capitalized if certain criteria are met. Always include them in budget and forecast from the beginning. Channel sales impact. Selling through distributor can be appealing for scale, but it reduces the margins and slow cash inflows due to the longer payment cycle. It's critical to reflect these dynamics into our model, like commission cost, payment delays, return provision. In some cases, a hybrid sale model may become more profitable. In summary, financial projections are both an art and science. Avoiding these common pitfalls can help us to produce models that are not only realistic and defendable but also strategic. If we want to secure the investment effectively, our number must tell a story grounded in reality. Thank you for watching.